Hello viewers, welcome again to Already Late. While the economy came to a near standstill since the lockdown, the stock markets have refused to even slow down. The markets have been swinging wildly on both sides, leaving many investors disturbed and rightly concerned. In this video, I will share some insights on our economy and draw some inferences from these insights to give you a fair idea of what may happen to the markets in the near future. I will end this video with some ideas on where you should invest and also what you should be doing if you are already an existing investor and suffering losses. So stay with me till the end to know the way ahead. While we talk about economic growth, there could be many factors. I'll restrict myself to three. I'll start with the most popular indicator, which is GDP and GDP growth rate. Before the COVID outbreak, Indian GDP was growing at 4.5% and was expected to grow at a rate of 5% to 6% for the next couple of years. The current government had been ambitiously setting its eye to take India's GDP from $2.8 trillion right now to around $5 trillion by 2025. A task which looked very challenging even before the pandemic broke out. With the lockdown, this target is now next to impossible. Our GDP is now expected to grow between 0.8% and 1.5% for the coming year. And these forecasts are with assumptions that there will be no further lockdowns. Any further lockdown will only result in further downward revisions on these forecasts. Honestly, I will not be surprised if we end up with a negative GDP growth rate for this year and recover from there. The next important number to look at is that of unemployment. A lot of people have lost their jobs in the last 6 weeks due to the pandemic. The latest unemployment data, which we get from CMIE, Center for Monitoring Indian Economy, these shows that the figures are at 23.52% for April. And this unemployment rate was just 8.7% in March. So you see the impact in 1 month. Now this was expected because with most economic activities coming to a standstill, it was impossible for every business to continue maintaining the same number of employees. The smaller businesses have suffered the most because obviously they do not have the kind of resources, the capital, the funds which are required to cope up with this kind of a pandemic situation. The forecast for unemployment for the coming years, the next 2 years, next 12 months, are also in the range of 10 to 11%. Again, with the expectation that there will be no further lockdowns. Another related factor has been salary cuts for many employees who have been retained. This means that there will be lesser money available with individuals even after normalcy is restored. Another important way to assess the situation right now on the ground is to check the response to the 3-month moratorium which was announced by RBI governor, and he advised all the banks to pass it on to the customers. While we do not have any official accurate data on the number of people who have opted for these and the value of these loans, there have been a few important comments made by industry professionals on various occasions. And these comments are worth taking a note here. Axis Bank, in its conference call for the investors, for the analysts, indicated that roughly 10% of its clients have opted for moratorium. And these 10% clients accounted for 25 to 28% of their full loan book. SBI, HDFC Bank, Kotak Bank, IndusInd Bank, all of these have indicated that those opting for moratorium are largely the small and medium enterprises. A report from credit rating firm ICRA mentions that there are 328 companies which have opted for moratorium. This list includes some very popular names like Tata Power, JSW Steel, Kalyan Jewellers, Future Group, among others. Another observation is that many retail customers have opted for moratorium despite having no impact on their salaries. Probably they are worried about their near future and want to retain cash. Mahindra Finance, an NBFC, has indicated that almost 75% of the customers have opted for moratorium, and this number is expected to rise further. NBFCs like Mahindra Finance lend largely to those individuals who have a slightly weaker credit score. The CIBIL score is on the lower side, due to which these customers do not get loans from banks. So not surprising that people who did not have a good credit history are finding it difficult to repay. These numbers are again giving us a clear understanding that the economy is definitely not in the best of shape. It is definitely in a bad shape. So far, what we have seen is that it's all gloomy and our economy has virtually been destroyed by the virus. But is that all, or do we still have a light at the end of the tunnel? There are at least three things that still can help revive our economy. The first one is interest rates. We were already witnessing reduction in interest rates even before the pandemic broke out, and RBI has responded with further cuts, deeper cuts, post the lockdown. The rate cuts are expected to continue for some more time, and this will boost liquidity. This will add to the liquidity in the economy. The repo rate could even go below 4% in the next couple of quarters. Now, lower interest rates means lower borrowing rates both for consumers and corporates. They can borrow, they can probably spend more. That is what RBI and the government will be hoping, and this is how the economy can be revived. Lower rates will definitely add as a booster to economic revival. The second factor, which is related to the interest rates, is inflation. One reason why RBI has been able to cut rates so easily is due to lower inflation. Current retail inflation is at around 5.9%, and this is expected to go down to below 4% in the second half of the year. Lower inflation will help people to tide over this crisis with lesser pain, and it also gives room for RBI to implement the rate cuts, which I was just talking about before talking about inflation. The third important factor here is the global prices of crude oil. Crude oil has been at low levels for over the last 6 months now. India's largest import. We are the biggest importers. Our biggest import is crude. Then comes gold. Lower crude prices have definitely come as a big boon, a blessing in disguise for the government. Lower crude generally results in lower prices of petrol and diesel. However, the current strategy of the government has been to increase the excise duty on petrol and diesel with a clear objective of collecting additional revenue. No matter how much we can collect additionally, let us collect. With the latest increase of 8 rupees today, we now have a dubious world record. We are the country with the highest taxes on fuel. Honestly, I don't blame the government a lot because government is in urgent need of money, and any source of revenue is acceptable at the moment. It could be fuel, it could be liquor. While this will not hurt right now, it will not hurt us right now because we the citizens, we are traveling less. We do not, we are not traveling back. We are not back to complete normal traveling. We are still at home, lockdown, working remotely. But once we are back to normal, I'm sure the government will have to review this strategy, and hopefully the government will reduce taxes, reduce the prices of fuel, put more money in our hands so that we can decide what we do with that money, spend or save. With lockdown restrictions easing across the country, they started easing at few places, and in the next few weeks you will see the lockdown restrictions easing. And you will find that every business will start its operations. Car companies will start manufacturing cars. Apparel manufacturers will start producing new fashion lines. Multiplexes will start screening new movies, and flights will start operations. But the larger questions are, will we start frequenting malls, go out for dining, partying? Will we start going to multiplexes immediately after these businesses reopen? Will we see more people buying new cars? Will you buy a new car immediately? Will we start planning a vacation? The answer is a big and a resounding no. There will be a significant change in the behavior of every individual's consumption. Our consumption pattern and our lifestyle will see major changes. This means that malls, restaurants, multiplexes, hotels, resorts, the auto companies, the car manufacturers, and the apparel manufacturers, they will have to put in that much extra effort to entice you and me to come back to the pre-COVID consumption behavior. Now, as a consumer, be rest assured, अच्छे दिन आने वाले हैं. Further, this change in behavior has resulted in a change in mindset towards importance of savings and investing. I have personally seen this over the last 6 weeks. More and more people want to save. They are definitely more receptive to saving now. Spending on non-essential items will be more rational than intuitive. It will lead to higher savings and thus higher investments. So by now we have a fair idea about the state of our economy. It's a mixed bag and the road ahead has some tough challenges. We will need to give our economy a fair bit of time, maybe 6 to 12 months, to come back to the growth path. So now the important question is, when economy is in trouble right now, why are markets behaving the way they are? A quick look at the chart of Nifty, the flagship index of NSE, reveals that the markets were at around 12,000 levels in early January, and from there you see that the markets have gradually come down, sometimes at real fast pace, to around 7,600 on 23rd March, the date the lockdown was announced. Since then, you see, markets have been swinging on both sides. They're trying to recover, and currently they are at around 9,200 levels. Now, a couple of things that we should remember, we need to know about the stock markets. Let me give them to you quickly. First, markets always move ahead of the news and the reality. Markets always move on expectations, and they factor in a lot of future possibilities in its current value. That is why stock market movement is considered a leading indicator of economic situation of any country. So what happened between January and March was an indicator of signs to come. The signs which we are witnessing today and probably will witness for a few more weeks. The second thing that we should know about the markets is that stock markets in short run are always dominated by speculators. And speculators, why? See, investors do not need to participate on a daily basis in large volumes. They don't need to come in every day and pump in a lot of money or sell a lot of shares. It's always speculators who are busy on a daily basis. The volatility in markets always increase when there is uncertainty in the business and the economy. Currently, with this lockdown, nobody knows about its real and immediate impact. Hence, what you see is speculators fighting it out on a daily basis in the markets. If you are a speculator, you should do well to be in the direction of this swing. Speculators will continue to have a gala time as long as things remain uncertain. And you will definitely continue to see this yo-yo in the markets for a few more weeks. So what should investors do? If you are an investor, you should go back to remembering the first point about stock markets which I mentioned. Markets are leading indicators. They will always react before the actual event happens. So when economy improves, markets will not send out an invitation. They will not send you any notification on your phone, or you will not receive any intimation that, hey guys, we are about to go up. Why don't you join the party? You need to be in there before the economic revival happens. So my advice to those with surplus money, invest gradually for the next 6 months. It could be investing a little every day ideally or weekly, but stay invested and more importantly, stay disciplined. The next question, very obvious, is where should we invest? Ideally, a good multi-cap or a good large cap mutual fund. If you're looking at stocks as a direct investment, couple of advice for you. Avoid stocks with high debt on their balance sheets. You do not need a leveraged company at this point of time. Avoid those companies, those sectors which focus a lot on discretionary spending, like the consumer durables. If you are already invested and are seeing your portfolio in different shades of red, what should you do? Should you exit? No, now is not the time to think of exiting. Bulk of the damage in terms of the impact of the fall is already done. The magnitude has been severe and we have already taken that. If you want to get advice on your existing investment of stocks or mutual funds, do leave a comment saying need review. Just 2 words, need review. I will connect with you personally and definitely guide you on whether your portfolio is right or you should do something about it. So will Nifty come to 8,000 or 7,000 or even lower, or is the worst behind us? It should not matter to you if you believe that India will be back to the growth trajectory in 12 to 18 months time. Do not wait. You will not realize that you have already missed the bus. In this scenario, the early bird definitely will catch the worm. If you like the content of this video, please like it. If you want me to make more such videos, do leave a comment. Any topic that you want me to cover as a video, please leave a comment. You have any questions, ask. Do subscribe to my channel, press the bell icon to get immediate updates, and do share with anyone, it could be anyone who you think will learn anything from this. The objective is learning. Happy learning. Thank you.